Newspapers and online articles are flooded with traders claiming to have made so much money. All they need to do is sit down, do a bunch of jing bong and make a lot of cash. And I know you feel, if they can do it, why can't I? But the truth can be really different. I've been trading for a while now, so I'll give you an honest perspective on whether intraday trading can actually make money or not. So there's nothing wrong with intraday trading, and it's not that nobody makes money from intraday trading, but I think the expectations is a little crazy on the internet. So before we delve there, let's first understand what's intraday trading, what are the expectations versus reality, and then talk about if it's possible or not, and we'll also talk about situations where it's actually profitable. So let's start with the first thing. What is intraday trading? Intraday, as the name suggests, is intraday, as in within the day. Markets open at 9:15 a.m. and close at 3:30, which means you take a trade. Let's say you buy a stock at 100 rupees and then the market appreciates, that stock goes to 110. You exit that stock before the day ends, so it's intraday, and you make a 10 rupees profit. Now the cool thing is, if you had 1,000 shares that you traded with, you made 10,000 rupees before brokerage, taxes and all the other things in just a few hours. Another interesting thing you can do when you intraday trade is that you can profit if the market falls. And we'll talk about this later. But the point is that a lot of influencers online nowadays are making it look that intraday is an easy way to make millions of rupees, but the reality is completely different. So why do people like intraday trading and they're tempted to actually try it? Let's talk about the expectations that the internet will set for you for intraday trading. The first expectation it will set is low capital. Let me explain. With a small amount of money, you'll be able to control a large amount of stock. And because of this, your profit will also be larger. So if you are just an investor, the problem is if you invest in, say, a fixed deposit, it will give you 7% a year. That doesn't sound too interesting. If you invest in stocks, as we've explained before, you have to compound it for 5 years, 7 years, 10 years. Yeah, tab tak to budha jayenge. That's also boring. But with intraday, something interesting can happen. You will look at it and it will feel like you can make a lot of money with a small amount of capital. And let me show this to you with an actual example. This is Dabur. Now first, let's look at it from the perspective of a long-term investment. This is not investment advice. I'm just trying to show you what long-term versus intraday looks like, and also why intraday is a problem. So in Dabur, the stock is trading at about 650 rupees. So let me do one thing. Let me show you the funds in my account. I have 12,017 rupees in my account right now, which means I can only buy 12,000 rupees worth of shares for the long term. So let's see what that looks like. I will open Dabur shares. I'll open the buy. So this buy order basically shows that I'm going to buy Dabur on this exchange. It's one quantity and the amount is 653. Amount is, like you guessed, you pay this to get one share of Dabur. So since I have 12,000, let me change this to, say, I guess 15 and refresh it. And I'll see that it shows 9,800. 9,800. I have 9,800. That means for the long term, I can spend 9,800 and buy this stock for a long-term investment. But now let me switch from long-term to MIS. MIS means intraday. Let's see what happens, and keep your eye on that amount area, which says 9,800 right now. So I'll change it to intraday. See that? It's become 1,900. So let me get this straight. If I want to invest long-term, 15 shares, all I can buy. But if I want to intraday trade, 15 shares only costs me or requires a margin of 1,961. This means since I have 12,000 rupees, I can trade with more, right? So let me change this to 90. Okay, 90 quantity. So 90 shares, if I trade, I will require 11,746, which otherwise would have required a lot more money for an investor. But for a trader, instead of trading just 15, I can trade with 90, which means my profit will also be larger. And so will my losses. But it doesn't matter. Traders, especially beginners, are big optimists. So let me place an order and actually buy this stock. I place this order and I'm going to the order window and I can see that Dabur has been placed. And you can see why this leverage increases your profit multifold if the market goes on your side. But you know what? That is precisely the problem. If this stock falls by just 1% and I am 10 times leveraged, I will lose 10 times more. Just because your broker allows you leverage doesn't mean you should use it. Leverage is a double-edged sword that beginners should not touch. Now imagine this. On one side, if you had taken a long-term investment with 15 shares, and on the other side, you had done this intraday trade with 90 shares. And let's say Dabur moved up in our favor by 10 rupees in just a few minutes. 10 rupees multiplied by 90 would be 900 rupees profit in just a few minutes. And over here, it would be just 150 rupees. So you can see clearly why people think less time, less capital, very exciting, very spicy, boring, compounding, old people do this, मैं तो bore हो जाऊंगा. The difference is massive. People think that they can make small amounts of money really quickly. But imagine if just the opposite happened. It fell 20, 30, 40 rupees. What would happen to this trade? Also imagine that you were doing this with a larger capital like 1 lakh or 2 lakh. Could you really lose 10%, 20% in just a few minutes? The answer is yes, you could. The second expectation that you'll be sold on the internet and by all these people is guaranteed returns. Now, hear how this story goes. People will say, if the market goes up, an intraday trader can make money. If the market goes down through something called short selling, an intraday trader can make money if markets fall too. Now, I remember around 2008 or 9, I met this one uncle and he said, Beta, I think, if you learn a little bit of analysis, trading can be very simple. I said, okay, uncle, what's your point? He said, very simple. I know that this company moves 10 rupees every day. I've been watching it for a while. Every day it moves 10 rupees. With some capital that I have, I'll buy 1000 shares. Whether I go long or short doesn't matter because 10 rupees to move kar raha hai. As soon as it moves 1 rupee in my favor, I'll exit and make 1000 rupees. And I'll do this a few times in the day and I'll walk away with 5 to 6,000 rupees a day. I'm a simple man. I just need 5-6K a day times 20 days I'll trade. I'll make some money. I'm happy. That's my strategy. That's not a strategy. That's a bankruptcy plan. And I'll explain how. 1. The costs of trading are more than you think. You will pay government tax. If you make a profit, you'll pay income tax. If you enter, you have to pay transaction taxes. So your entry, if it's at 100, it's not 100. It's 100 plus expenses, which means that the market needs to move a little more in your favor now for you to make that profit. Third, you have to predict the direction of the market. Now, we always imagine the markets are going sideways all the time and we will make 1,000 rupees and it'll add up to a lakh by the end of the month. This does not happen. Here is what's actually going to happen. You will take a long trade. You will wait for 1 rupees to go up for you to make that 1,000. But that day, the market will reverse and fall 30 rupees and you will lose 30,000 rupees. You will do this again and lose another 30,000 rupees, wiping away any gains that you made before that. Yes, I said gains. It's possible for you to make money sometimes when you do this, but 1, 2, 3 bad trades will wipe away everything and take away that capital too. So now let's come to point number 3, the magic strategy. Basically, you will get one strategy online or you can read a book and you'll feel like you figured something out. Let me show you an example of what a strategy looks like. So what I'm going to do is I'm going to open a 10-minute chart of Dabur, choosing this stock completely randomly. And I've added the magic moving average over here. This magic moving average is orange in color and it's a 100 moving average. What it is it's tracking the average movement of Dabur over the last 100 bars. Each bar is 10 minutes long. Now, all you need to do is look at it. Whenever the price comes close to the orange line, after some time it bounces back. See, over here it's bounced back, over here it's bounced back, over here it's bounced back, over here it's bounced back. So all you need to do is track when the market comes close to this. Then once it starts moving up, you buy it and you'll make money on the way up. Like look at this. Over here on this day, from the orange line all the way here, the market moved up a full 2%. But let's look at it a little closer. Here you'll notice the market came down. You would have bought it here, but the market fell completely. Now you'll think that the market went up, but it's intraday. Actually, the day ended. So you would have had to close your position and the market, well, gave you a loss. So this would have been a loss trade. Uske baad the market gapped up, went all the way up. There was no way for you to enter because it just moved very quickly and you missed the entire move. The same thing happens again and again until you see a sideways market. The market touches the orange line multiple times during the day. You would have tried to enter multiple times and gotten nowhere. So looking at this strategy from afar looks really good, but executing it intraday changes a lot of things. The market can just gap up, it can gap down, news will affect it. But the amazing thing about a magic strategy is it will always feel like if you make money, you'll feel like a king. And if you lose money, it'll feel like you just didn't analyze enough. Maybe if you add one more rule, one more technicality, next time you'll be able to catch the trend. The final expectation is probability. If you understand this, you'll understand the entire game of money. Now you'll think a trader, a successful trader, probably makes money 9 out of 10 times. This is not true. Most traders make money 50-50 or 40-60, which means 40 trades make money, 60 trades lose money. So that's 1, 2, 3, 4, and they lose the rest of the times. It could also be that they're making money only 3 times out of 10. But the difference is when they make money, they make a little more than how much they actually lose. And just that difference of how much they make makes all the difference. And this is called a risk to reward ratio. So they make a little more money than they lose. So 1:2 or 1:3 is quite common. But that difference is how they actually make cash. Now understand this. In trading, you have to take multiple trades and be right many times. And every time you are right, you'll accumulate that into a profit. Now let's compare this to, say, Warren Buffett's portfolio. Warren Buffett's portfolio is very different. He may have a worse loss rate than this. He would have probably invested in many stocks over his entire lifetime, but a few of these stocks earned him all this money just like that. So what's the bottom line? Can you make money from trading? The answer is yes. Just like any other profession, if you spend loads of money, time, effort to figure it out, of course you can. All these hedge funds over here actually make money from trading, but they don't approach it as a get-rich scheme. They treat it as a business, mathematically figure out how the market works and make money over a period of time.